Good morning, everyone. This is Beth Brickloves with IMS Life Insurance Sales Director. I have Paul Huber on the phone with us from Allianz. I'm really excited to have him on here today. He's going to talk about a lot of great features that are going on with Allianz with their underwriting upgrade, as well as other features of their IUL product. Before we get started, I will go through a quick intro to IMS because we do have new agents on the phone as well as existing agents that may not know about some of the value of doing business with IMS. So first, if you are a new producer, we do the new producer builder. We want you to get into production as quickly as possible and reward you for doing so. So the levels that you see up here are all annuity levels. Life insurance, how that equates is going to be if you do 100,000 of annuity production or 10,000 of target life insurance production in the first 6 months. You can choose from those things listed up there: the mailer, the iPad, the cash. Of course, if you are writing more than that, 25,000 of target, the rewards get bigger, and you can cash out anytime during that 6 months. So the best way to know if you're getting good service from IMS is to test us out. And so we want to get you into production as quickly as possible so you can see how our operation works. After that, we do have other rewards for continued business with us. One is our business isn't that much different from yours, and that referrals are part of the best part of our business is getting an agent that that's successful that could utilize IMS services. So we do offer a $50 one-time bonus, and then for all the business that they're writing, we also will give you a little bit of an override on that business. That's not a haircut to their commissions or anybody else's. That comes out of IMS' pocket. We also do marketing reimbursement. We want to reward you for doing business with us, and by giving you money for marketing reimbursement, we know that you're going to be able to increase your sales. So $100 of marketing reimbursement for every 100,000 of index annuity premium. That's going to equal $200 per 100,000 of single premium life, and $200 for every 10,000 of target life insurance business. We have excellent back office support. That's really what is the most important thing, I believe, is that once you get the business in, how do we get it? How do you get a prospect in and move through the underwriting process so that we place business to help families and also make sure that you're getting paid quickly. So the website is an excellent resource. If you have never logged into our website, it's just www.ims.com. Get registered for that. There's going to be a lot of information there. You've got your case design assistants. That's going to be talking to me or any of the life insurance sales directors, or on the annuity side, any of your annuity sales directors. Forms at your fingertips, either by calling a director to get that to you, or they are on our website. We do track down commissions if you are needing any help on that. Life and annuity quotes, and you're talking to experienced directors both on the life side as well as the annuity side. Again, I mentioned the website. There are a lot of great sales tools on here. One of my favorites is if you go to support, there's a sales resource library, and you could spend hours in there getting information. There's sample documents, there's fact finders, there's PowerPoint presentations. I get on there often, and I learn new things every time that I'm on that. There's a term quoter. It does more than term quotes. It also does your guaranteed or no lapse guaranteed universal life. It's always accessible. You can get forms for just about anything, both pre-sale and service forms. There's industry links, and then there's all the product grid, so you can see what products we do offer through IMS. There's a couple of ways that you can submit business online. Submitting business online has really, that's how most of the agents are continuing to write business versus a paper app. So there's Firelight that we use, and then we also have IGO eApp solutions. Firelight is going to be mostly annuity carriers that do the Firelight. IGO eApp solution is going to be mostly life insurance, although I think Allianz is on Firelight, not IGO eApp solutions. And then American National has their own portal on our website. So several different ways to get an eApp. We find that this business goes through a lot quicker. There's a lot less mistakes if you adapt to the eApp process or the electronic form of an application. Here you can see the different annuity carriers that are on Firelight, as well as the life insurance. And then if you don't see life insurance, the life insurance company that you're wanting to submit business with, then I would check with IGO eApp. If you have questions on that, any of the life insurance sales directors can help walk you through that. We have a wonderful creative marketing team that has all kinds of solutions for your marketing, whether it's business logo design, ideas for social media, websites, just about anything that you can think of. If you haven't already, we offer a marketing analysis for free. So get with one of your sales directors, either on the life or the annuity side, and ask about that marketing analysis. It's a short form to get a picture of where your marketing efforts are right now, if any, where you want to go, and then we turn that over to our creative marketing team, and they come out with, bullet points, point by point, what you need to be implementing to achieve the sales goals or the marketing efforts that you're wanting to have done. We do, on the annuity side, work with Retirement Analyzer. So if you have, if that's something that you're interested in, I would talk with an annuity director. But that is a great way to get a picture for a client of where they are and what that projects out to be when they do retirement, and what suggestions need to be tweaked so that they get to their retirement goals. We also have IMS Wealth Management. So if you are considering or already managing money, I would definitely take a look at IMS Wealth Management. Over there, you'd want to talk to Duncan, but that's a great way to get an extra piece of someone's financial, the financial relationship that you have with somebody, not only on the insurance, but on the managed money. If you aren't into managed money at this point and you want to, I would definitely talk to Duncan, because he can walk you through on how do you implement that into your business. And as always, make sure to follow us on Facebook and LinkedIn. Take a look at our YouTube channel too. We have all kinds of educational information on the YouTube channel, like this webinar today will be posted. And with that, I'm going to go ahead and turn this over to Paul, if I can remember how to do that. 1 second.
This is always the fun part, right? The cumbersome, turning it over, making sure everything works.
All right, here we go, the magic button.
Okay, show my screen.
I can see it.
All right, let me blow it up so we can see it better, hopefully. Let me know if
I got it. It looks great to me.
Perfect. I'm going to give it 1 second. We'll jump forward. Looks like the slide advance. Does that work for you, Beth?
Yes.
Perfect. Well, thank you very much, everybody, for joining me today. Again, my name is Paul Huber with Allianz. I've been with the company for 20 years, a little bit more. Spent the majority of that time working on the life side, specifically the indexed universal life side. So today, I wanted to talk to you, about where Allianz fits on the life insurance side, why universal life, what makes us different, and really specifically, I think the bulk of today's conversation is going to be talking about volatility controlled indexes. It's definitely the hot topic that's out there in the market. So we'll go a little bit around who is Allianz, what makes us unique, and how that plays into the whole volatility controlled index story. You can see from just a company standpoint, Allianz Life of North America, we focus primarily on annuities and life insurance products, financial retirement products. However, our parent company is Allianz SE in Munich, Germany. If you guys happen to get up early, depending on where you were at yesterday, and watch Tampa Bay play Seattle, that was actually held at Allianz Field in Munich, Germany. Kind of exciting to see the the mothership, so to speak. Great field, great environment, and I think it was a pretty popular football game. I heard something in the neighborhood of like 3 million people were on hold to buy tickets for that game when they released that the NFL was going to Germany. So kind of a cool story, but I digress. You can see that Allianz is one of the largest insurance companies in the world, depending on the day. We go anywhere from number 1 to number 3, depending on which stats you're looking at. But know that we have the support of our parent company, being in over 70 countries, across the world, being one of the largest insurance carriers in the world. We're here. We've been doing it for over 125 years. We're looking to do it for a whole lot longer. When it comes to our ratings here in the United States, you are never going to have to apologize for Allianz's ratings, whether it's S&P, AM Best, or Moody's, some of the best insurance ratings out there. Comdex of 94 is also one of the best insurance company Comdex scores that you're going to find. So again, never have to apologize for the carriers that you're working with or be concerned. We're in it for the long run. We're not doing what's best today. We're looking at what can we do for the customers for the next 10, 20, 30, 50 years. I like to bring this slide up, in talking about Allianz Life of North America. We really built this company on FIAs, fixed index annuities. And when you see the slide down at the bottom part of the slide, you can see that the annuity side has been number 1 in fixed annuity sales. I think we're at 18 out of the past 21 years. And there was a time in 2008 that I think we had a company jump up, take over, and you see Athene has done a great job in the last couple of years. But for the most part, we have been there and been number 1. When you look back at the life insurance side, we may not be number 1, but that's because we offer one product on the life insurance side, where most of these carriers have several different products, whether it's term, whether it's GUL, whether it's a current assumption product. And as you look at their index products, they're working with a lot of different products to build up that book of business, where we have just one. The main thing I like to point out, though, is that we are the only carrier that you see repeatedly show up in that top 5 for both life and annuities when it comes to indexing. We're in it. We're committed to the index market space. This is what we do. It's what we do very, very well. And we're here to do it for a long time, and we want to keep pursuing that. And as we get into talking about hedging and some of the things I'm going to be talking about, know that it's the bottom half of the slide, the indexed annuity side in that book of business, that has really got us to where we are and allows us to do some of the things we do. Talking about hedging, when it comes to these index products, the way they work is, we come up with, say, a cap. To keep it simple, if we talk about, say, the S&P 500 and we have an 11% cap out there, how do insurance companies get your client an 11% return in the marketplace, right? They're not actually managing it themselves. They're not going out there. They take your client's money, they go to an investment bank and say, I promise this customer, if the market goes up 10% or 11, they're going to get all that or anywhere in between. And they sell off or buy a hedge from an investment bank that will mimic what the market does. So at the end of the day, when they come back to their customers, they can give them the return that they were promised. Now, at Allianz, we realized over a decade and a half ago on the annuity side that as we were doing this, those investment banks were timing us. They were playing games with us. They were raising prices when they knew we were coming for our options and for our hedges. And we really looked and said, we think we can do this better. If we do it ourselves, we can eliminate the middleman. We can eliminate paying those fees, charges, and costs because these investment banks aren't doing this for free, and we can save some money by not paying somebody. We started doing it. We convinced our German parent that this is the right thing to do. And after 15 to 16 years now, not only has it turned out to be the right thing to do, but Germany is now having us hedge the entire global portfolio. Any carriers that have index products, they send it to Minneapolis for our third floor team to manage it. And that hedge that we're managing is somewhere in the neighborhood of $150 billion a year. Now, keep in mind on the life insurance side, if you took all of the IUL carriers combined and you put our portfolios together, we're just starting to get close to touching that $150 billion that the annuity side has. That's all carriers combined equal what our indexed annuity side manages. So kind of nice for us to jump on board, get their size and their scale and use that. So what does it mean for us to hedge our own products? And you'll hear a term static hedging or dynamic hedging. Static hedging is what the other companies are doing, going out, passing that risk, and only worrying about what happens today, the day that they're buying that hedge. Dynamic hedging is making those changes and buying options and trading them daily, which is what Allianz is doing. We're trading notionals in the amount of almost $1 billion a day, multiple times a day to manage the hedges and the promises that we have for our customers. Now, what we found on top of saving that money and not being, beholden to the investment bank is we're able to purchase higher grade bonds. We have less market exposure and investment bank failure. We're able to come up with innovative features, designs, different crediting strategies that really solve some of the questions and the problems that your clients have on the indexing side when they're looking for it. And all of this has led to kind of where we have got. When we look at the savings of what we're doing, keeping it internally over the past decade and a half plus, we've calculated that it comes out to roughly $2 billion of savings that Allianz has had by not using an investment bank. Now, you may say, Paul, that's great. How big is your house? What kind of car do you drive? Allianz is kicking that bonuses back to their shareholders. That's not the case. Those $2 billion of savings is going back into the products. It's going back to higher caps. It's buying higher quality bonds for the general portfolios. It's going into features and benefits for the product itself. And we're really passing it back to the customer to making sure these products can be all that they can be. So it truly is a better mousetrap when it comes to our indexes. You can see here some of the innovative index strategies that Allianz has come out with over the past 2 decades. Monthly sum was created back in 2005. The markets were doing great, right? We kind of rebounded from those early 2000s slumps. People were seeing, they can turn on the news, the S&P is up 30%, and they were wondering how come their 10% annuity cap was only getting them 10%. Today you're looking going, wow, I wish I could have 10%. I think with interest rates, we're starting to creep back up into those rates. But a monthly sum allowed the clients to get double-digit returns, right? And start to see those 20, sometimes even 30% returns on the products when the market was doing well. In 2008, we had customers that were looking for exposure to more, different markets. They wanted markets in the bond side. They wanted markets internationally. And the blended index was a strategy that we came up with that helped out. 2014, you can see the volatility controlled indexes. Allianz introduced the first volatility controlled index in 2014. When it comes to volatility controlled indexes, it was really just a matter of we were working with low interest rate environments. And on the annuity side, you were seeing customers going, well, I don't want just 2% or 2.5%. When the 10-year treasury was at 1, they wanted more upside for locking in their money. By targeting market volatility, it allowed us to buy some cheaper bonds and options and give more upside potential. Cheaper options, more upside, meaning that the customers could get a bigger return than, say, that 2.5% in some of those annual point-to-point caps that were out there. When we put it on the life insurance side, all of a sudden you saw spreads disappear. You saw participation rates go from 100 to 120, 30, 40, now up to 100, I think, and 85 in some cases. A lot of upside potential. And again, that came from Allianz looking at what can we do better for our customers? And then as we look further on, we get into index lock and rate lock, which we'll talk about quite a bit here in the future. But again, Allianz has been looking for solutions to answer questions and concerns our clients have. One of the things that you'll see is, we get into some of the details of volatility controlled indexes. A lot of these investment banks aren't necessarily answering or trying to find solutions to your customers' problems. What they're doing is creating back testing strategies that look really, really good, what used to happen, but we don't know how they look moving forward. We'll shift gears real quick and talk about just the Allianz approach. When you're working with Allianz and submitting cases, know that you have a dedicated team. You have me. I am committed to working with the IAMS team and making sure everything goes great. I also have 7 wholesalers throughout the country that are in kind of territory or zip code. So it doesn't matter if you're up in Maine or you're down in Texas. I have somebody that if you need somebody to sit knee to knee, have conversations and share sales ideas, or take you out for a cup of coffee, we can get somebody connected with you. So please let me know, and I can tell you who is in your area and who can reach out to you. The same thing when you submit your business, you're going to have the same case managers, the same new business team, the same underwriters. They're going to get to know your business, how best to work with you, and make sure that we can process it as quickly and as efficiently as possible. So let's talk real quick about the one product that I have, the Allianz Life Pro Plus Advantage. This is an accumulation-focused product. It's not designed to be cheap. It's not designed to be low cost. We are typically running this product to show maximum income. You're talking minimum death benefit, overfunded policies, taking loan strategies out, that sort of thing. That is typically what we're using our product for. That's not to say that it 100% has to work that way, but that's where the bulk of our business is coming in. Looking at some of our index choices, and we'll kind of jump in. I said this is going to definitely be index and volatility controlled heavy. You can see that we have really 5 different choices, 4 indexes with a fixed account. Fixed account, I believe, is paying 4.7% right now, so a great option if you're looking for just a little bit of a guarantee. We have the S&P, which is the old tried and true, our blended index. But most of all, what we typically see customers using is the Bloomberg US Dynamic Balanced Index ER, or our PIMCO Tactical Balanced Index ER index. Both of those are volatility controlled indexes, and I'll get into their features and what they're comprised of in just a minute. A lot of carriers, up 2 or 3 years ago, I think 75% of the industry was using the S&P 500. Allianz has seen 95% of our business go into, typically speaking, something other than the S&P, whether it's the BUDB, the PIMCO, or the blended index. Again, we feel we built a better mousetrap, and we're seeing customers use that and try to take advantage of the indexes we offer. One of the stories I like to tell is talking about volatility controlled indexes. Again, we came out with our first in 2014. Before the world shut down with the whole pandemic and COVID. One of the last meetings I was at was a big industry event for a large national sales organization. And we had roundtables, and we were doing these speed dating events with different IMOs like IAMS coming in to talk about what carriers like. And as I walked around the ballroom with all these tables of different carriers and my competitors, there was definitely a common theme, and that common theme was volatility controlled indexes are smoke and mirrors. They don't work. Don't trust Allianz. You don't want to use it. Use us. Stick to what we know. Stick to the S&P 500. That was what I heard all the time when I went to competition. Fast forward around 3 years later, and we have somewhere in the neighborhood of 157 different volatility controlled indexes that are out there, between the annuity side and the life insurance side, right? Everybody has come up with a volatility controlled indexes. The investment banks have gone back tested and created a lot of different strategies that they have been pushing, and carriers are grabbing onto them. And we'll talk a little bit about what to ask and questions and things to look for. I think the best story I can tell you is that we had an actuary here at Allianz. And if any of you guys are Final Four college basketball fans, Like every company, everybody's got brackets that they send out, and you jump in a pool and participate in March Madness, right? Now, this actuary put together an algorithm and went back and back tested the past 10 years of the past 10 Final Fours and all 64 teams that went, and he created an algorithm that was able to accurately predict the winner of the past 10 tournaments, each game. So if you look at every single game start to finish, 90% of his picks were accurate of saying, hey, if Michigan's playing Michigan State, Michigan won, and that's what actually happened. So he created this algorithm. It predicted what did happen the last 10 years and created it and back tested to make it work. He then thought, now keep in mind, I'm a sales guy. Sales guys have very different hobbies than actuaries. So I would not be doing this. I have a lot of other things I'm doing during the weekend, which don't involve spreadsheeting and documenting. But this is what the guy did. And when it came to last year's Final Four, he was super excited to put this algorithm into play. You get a couple hundred people into a basketball pool, and he's going to win it for sure. Take a guess of where he finished for his bracket last year. He finished in last place. What that tells you is that you can backtest and create overfitting is the term that the industry uses. You can overfit an algorithm to make it work for what happened in the past. That doesn't mean it's going to happen in the future. So keep that in mind as we jump in and talk about these VCIs and some of the other carriers that are out there and what they're using. Now let's break down what a volatility controlled index does real quick and just talk about it in its most simplest terms. If you were a prudent investor and you're out following volatility, what it says is if volatility goes up, you should move your investments towards safety, right? Get out of equities, and that bond side, the left side there, should be more heavily weighted towards bonds when volatility goes up. As volatility goes down, you need to get the heck out of bonds and safety and start moving your money towards the equity side of things and take advantage of the upside and the less volatile markets and what happens. Quite simply, a volatility controlled index has an algorithm and has features that does just that. It shifts the weight of the index between bonds and equities based on certain parameters. That's its simplest form, right? When the market is going really well and volatility is down, you are in a heavily weighted equities index that should work very similar to the S&P 500. It should give you a lot of upside, and in our case, a high participation rate that's going to give you a lot of exposure to the gains. On the flip side, when we have the market flip over and volatility is high, you're going to be in the bond side, you're looking at safety, and instead of getting those high rates, and instead of being, say, 10% below, maybe you're sitting at 1 or 2% and getting a small gain. That's the simplest version of how volatility indexes should work. However, if you start to compare and ask questions, what components are they using? Are there spreads? Are there fees? What are the index rules that make it managed back and forth? All these can be found in the brochures of those different pieces that you're out there. How many different index components? What's the length of the history they've been out there? What's the carrier's experience with it as things change? Again, they're beholden to the investment bank. So if the investment bank increases prices, well, just know that the carriers aren't paying the increased prices. Those are going to be spread back to the customers by having lower caps, lower participation rates, that sort of thing. Here at Allianz, we want to keep it simple. We want to keep it, and when I show you the breakdowns of our BUDB and our PIMCO index, we tie it to a simple equity index and a bond index, and short of the PIMCO, which has a little bit of cash exposure, that's about it. As you get into some of these other VCIs out there, they may be tied to 6 or 7 different, whether it's commodities or different investment vehicles, which is going to make it really hard when things don't go well. How do you explain what works well? It's pretty easy right now to say, hey, markets are down, volatility is super high. You might be weighted heavily towards the bond side, and we know interest rates are going up, which means the bonds aren't performing. That's a very easy story to tell. And when the markets flip and go the other way, it's very easy to explain why things are going really well. Again, fees, spreads, and management actions, I would caution you on this. Look at and read those brochures to see what fees. Now, these aren't fees that you're going to see the customer actually paying for. This is the hard part, right? Is that it's not like it's in the illustration and showing you as a fee or a cost to the policy. However, what it means is it is a drag to the actual credit that the investment bank is giving. So if a cap is, say, 10%, well, they may have returned 13, but the cap was put down because they're taking some off the top to give back to that investment bank. You're not going to see it in any illustrations. You're only going to see it by reading the brochures of what those fees are. And again, you don't know what you don't know. So make sure you're asking questions when you're looking at other carriers' volatility controlled indexes. What are they doing? And again, a lot of them may lock you in and require you to use them to get certain features on the product. Again, we want to keep it as simple as possible. At Allianz, you have the ability to change, move, manage your allocations every single year on the anniversary. For us, we don't care which index you want to use. We're paying the same amount for the different caps and spreads that we're offering in all these different indexes. Again, you heard me mention the PIMCO and the BUDB. Let's run through them real quick. You'll see with the BUDB, we use the Bloomberg U.S. Equities Custom Futures ER Index with the Bloomberg U.S. Aggregate Bond Index. Again, pretty simple. We have just the two equity and the bond component and move back and forth. We've given this algorithm to Bloomberg. Allianz cannot change or make any tweaks or adjustments to this. It is what it is. How it performs is how it performs, and that's where you're at. So again, keep it simple, no fees, no charges, no spreads taken out of it. As we look at the PIMCO, you can see that it is a very similar index. However, we're using two different components for the equities and the bond component, using the U.S. equities future and the PIMCO synthetic bond ER index. One of the reasons we use futures for this, it was really actually two reasons. The first one is a few years ago, we saw that typically it's the 10-year treasury is what dictates what we have for our budget. However, the 1-year treasury had spiked up and gone above the 10-year treasury, which started to make options very, very expensive. And it meant that your caps and your par rates were fluctuating greatly on a lot of these different indexes. So we moved over to a futures-based index, which kind of locked in and eliminated those high interest rate 1-year charges that we had, making the options a little cheaper. One of the cool features is it means that in real time, what you have for a value of the policy is what we're able to get from it. And a little foreshadowing, when we get to the index lock feature that we're going to talk about, using the futures index or equities portion of this is what allowed us to add that auto lock feature to the policy. One of the cool things in looking back is we do actually have historical data. This isn't just back testing numbers. You can see when you go back and look at how they performed that both the BUDB and the PIMCO have performed better than the S&P 500. And when you look at the number there for the BUDB at 8.02%, those are real numbers, what our clients actually saw credited to their policy. This isn't back tested, that overfitting I was talking about. This is real life experience of what our clients have seen being in the BUDB versus the capped S&P 500. So again, what has happened in the past and where they're at, they are definitely seeing a better mousetrap. They're seeing more upside potential with BUDB. One of the other things I'll point out as you're looking at the two volatility controlled indexes, the markets are sitting, year to date down somewhere in the neighborhood of like 10 to 15% down. The BUDB and the PIMCO are actually probably at about 2 to 4%, depending on where you're at, down for the year. Now, that may not sound like something super great or fantastic, but if we do start to see now past the election and the market rebound a little bit going into next year, that means that the BUDB and the PIMCO have a better chance of getting some return than say coming out of that 10 or 15% hole that the S&P is in right now. So again, a better chance for some upside. I'll talk real quickly about the bonus options that we do have on our products. You can see that if you want to keep things simple, we have a standard no bonus option. We have a classic bonus, which is a 90 basis point guaranteed bonus. This is what the illustrations will default to. This, if you want to run the best showing illustration, this guaranteed bonus is the one that the AG 49 rules allow us to show. However, we see most of our customers look to using either the bonus at that 15% multiplier or that select index at the 40% multiplier. The reason being is you're already in an index product, having more upside and having a bigger bonus tied to your index performance. We've seen customers take advantage of those kind of non-cap bonuses and multipliers. The one negative to that is the illustrations do not allow you to show that. So from an illustration standpoint, it is not going to look as favorable as that classic bonus. Having a conversation with your customers about which bonus is right for them. The classic is going to be for that client that wants to maybe never see a zero, right? Having a 90 basis point bonus, meaning that if they get zero, they still will get some return, may be helpful. However, if they have a little bit more risk tolerance and they believe that these things will return 4% or better, you'll see that the bonus or the select bonus option will perform better, mathematically speaking. If they're willing to pay that extra 1% charge and they are okay with having that risk of going -1 on a bad year, that 40% multiplier can be a good choice for them. If you want to keep it simple, you can use that standard no bonus option. Don't have to worry about it. And here's the cool part. What you're choosing today does not have to be what they're in for the future. So you can mix and match any of these bonus options. You can change them year to year as clients' needs and risk tolerance may change depending on where they're at and their, whether it's accumulation or retirement or whatever it may be. You've heard me talk a few times about rate lock. Rate lock is the ability for you and your clients to lock in the index gains at any point during the policy year. So if we start out with the policy today, I'm looking at it, we're at November 14th. Typically with a traditional index, we have to wait till November 14th of 2023 to see what our gains are. With rate lock, and again, because Allianz is hedging this internally, because we trade daily, because we created these indexes using those futures ER indexes, we are able to lock in your client's gains. So if they started a policy, we're 3 months in and they see a 10% return and they're happy with that because we may have illustrated 6.5, they have the ability to go in as of today, lock in those gains. They will see those gains credited at the end of their policy anniversary year, and they will start their new annual reset at the end of their policy anniversary. Again, if we're using today's date, November 14th, it'll reset next year and they'll see those gains credited to their policy. In addition to being able to go out and locking it at any time manually, we have an auto lock feature. So if you don't want to go out, check it every month, check it every week, and make sure you're looking at the policy, we may have a conversation and say, Beth, if after talking to you, I think 12% would be a great gain. We illustrated it at 6.5. So anytime we have the market hit 12, I'm going to set up a rate lock that we automatically grab that 12% and lock you in. It's something you can kind of set it, forget it for the year, and come back and you'll see that credit. If it ever does cross over, we will lock in that 12% gain. Now, bad news is if the market does go up and they could have potentially got more, they may miss out. The good news is that they don't have to worry if it's performing better than they illustrated. Obviously, that's a great thing. We're seeing this used as we look at kind of the history. This year has not been as great, right? The market's been down for the year, but last year we saw an average rate lock of 11.45%. I think the biggest lock that we had last year, a client locked in 32% on their policy. Again, that's pretty amazing. They didn't have to wait. I think back to 2020, as we're sitting here with COVID, election, we just crossed over last week's election. You're worried about what's going to happen. Your clients were sitting with some significant gains. It was a great time for those clients to use rate lock it in, not worry about what happened past the election, not worry about what happened if COVID reared its ugly head and kept going. They were able to put their money on the sidelines, take their gains, get the heck out, and wait for the next year. Again, we are the only carrier out there that has this rate lock feature. It's one of the reasons that separates Allianz from everybody else, and it is because of that dynamic hedging that we talked about before. It's because we have both our life and our annuity book of business that are tied to that $150 billion that we trade daily. You have the ability to go out and run your own reports. You can see if you go out to the website, pull up policies, and you can search for them based on, are they at a 1% return or a 10% return, or show me all my policies above whatever number you want. So you can look them up at any given time. It's a great opportunity to reach out with a positive phone call to your customers and say, hey, Mr. Smith, just wanted to let you know you're sitting at 12%. It might be a great time to have a conversation about locking in. If that's something you're interested in, let's set up a meeting. Again, we don't have a lot of opportunities to have those great calls. So take a look. Again, you're not going to see as much pop out now. Well, obviously the market's being down. There's a lot of below zero, but I think if we keep seeing some gains over the next couple of weeks, we're going to start to see some of those policies pop back up and show some returns. You may also be seeing emails from your territory reps. If you have policies that are above 8%, our territory reps shoot an email out to you, thanking you, letting you know, hey, take a look at these policies. They've crossed over an 8% threshold, to bring them to your attention. You can see, again, pretty easy to get out there, take a look at the returns for all the policies, all the different index allocations, everything else. I'll talk real quickly about loan options. Accessing cash in these policies is a key thing. I mentioned that a lot of people like to use them for retirement income. At Allianz, we have our standard wash loan. First 10 years, it's a 1% net cost loan. After year 11, it goes to that wash loan feature. We also have our index loans, which is the most popular option you typically see with an index policy, right? Having a client's money work for them while they're borrowing it, getting that arbitrage. At Allianz, the participating loan is contractually guaranteed at 5%. I think this is kind of cool because we were one of the few carriers that had a 5% guaranteed loan rate, and we saw a lot of other carriers over the past 10 years start to shift after they kind of threw stones and say, there's no way you can guarantee that, you shouldn't do that. They're coming out with a lot of options that look similar to ours. Imitation is the best form of flattery, right? It's one of the ways to take one question mark off the illustration for the customer, right? By knowing their loan is 5%, it's contractually guaranteed. They don't have to worry about it going up or changing. They know that it's 5% if they want to use it. Because we handle, as I have mentioned, several times now, that dynamic hedging internally, and because Allianz is making the trades, it gives us the most flexible loan features in the industry. We are able to allow you to rebalance and shift your loans between fixed loans and participating loans. You don't have to repay a loan for it to happen. You can simply just move it over on your anniversary date. You want to be 25% weighted to the index side, 75 to the fixed side, or vice versa. When you hit your anniversaries, you can change your loan balance at any given time. You can also tie specific crediting indexes to your loan balance. So if you had, $900,000 in your policy with a $100,000 loan balance, I could be aggressive and be in the PIMCO with that 40%, 1% charge bonus option, the $900,000. But if I'm taking out money and paying 5%, I probably don't want to pay an additional 1% charge on that. So I may choose to use a more conservative option, or use maybe that 90 basis point option, which means I'm going to pay back a little bit of that. I'll get some credit on that 5%. You can mix and match the most flexible loan options in the industry. When it comes to riders, again, pretty standard. We do have our chronic illness rider available in just about every state out there. You're typically looking at chronic illness versus LTC when you're talking about cash accumulation products. LTC, you're paying as you go, which is going to take away from your cash value. And if you never use those riders, they don't work out as well. With that chronic illness, you don't pay for it unless you use it. At the time you use it, then you see that discount, taken off the payments that are out there. Premium deposit fund rider. I think this is a great rider out there. If you have a bunch of money sitting on the sidelines right now for your customers, nice way to get them in the policy. They can pay the money up front. The money in the premium deposit fund rider will pay them a 3% interest credit back into the policy. They have the ability, once the money goes into the life insurance policy, it follows the life rules. The money that is sitting dormant in the premium deposit fund rider is 100% liquid. They can get in there at any time and take that money out if they change their mind or they need to do it. It does two great things for your customer. One, it takes it out of their bank account so they don't go out, buy cabins, boats, cars, new toys with it and forget about their premiums. It also takes it off the table for your competitors that may come in and say IUL is terrible, let's move this money somewhere. So when you come for your 2, 3, 4, 5 premiums, that money is still available and not sitting in somewhere, some CD or something that somebody else might have grabbed it. You can see we have a number of different options. Beth and I were talking earlier. We do have a term rider, supplemental term rider that is convertible for the first 10 years. A lot of terminal illness, everything else that you would expect. Kind of table stakes when it comes to IUL. One of the things I want to talk about, Beth alluded to it at the start of this, is we are currently doing a promotion from an underwriting standpoint. We are giving your customers an upgrade on their risk class. If we have a policy that has a $500,000 death benefit or greater, any case that comes in and the client is able to achieve standard non-tobacco will get upgraded to Preferred Plus, best risk class. Anyone at Preferred will still get upgraded to Preferred Plus, and even at standard tobacco, we will upgrade them to Preferred Tobacco risk classes. So the two caveats to this really are: one, we need a $500,000 minimum death benefit. Two, we are standard through Table 2. So if a client comes in and they truly are Table 2 and we upgrade them to standard, we will not give them the Preferred Plus upgrade. So we're super excited with this. This launched, I think we're at about 5 weeks ago, beginning of October. We're seeing a good amount of business trickle in. We're winning some cases over from some competitors, for the client looking to get a better risk class. Definitely a great opportunity to save your customer some money. If you're running one of those true retirement income scenarios where you're max funding, taking out income, with a 2 risk class upgrade, so going from standard to Preferred Plus, you're going to see probably somewhere in the neighborhood of 4% added to that income. So if a customer was seeing $100,000 of tax-free loans taken out per year, that might jump up to $104,000, $105,000 per year for simply just getting an upgrade in the risk class. So savings in costs, savings when it comes to getting more money back out. We're really excited to have this program. Make sure you give a call to IAMS. They have all the information. They can get you out everything you need. Run an illustration, take a look, lots of opportunity. You can see that QR code. If you want to get out and look at any of our materials, a ton of stuff on the volatility controlled indexes, our rate lock, different case studies. Click that QR code right there, and that will take you to our Life Sales Tool website. You don't need a username and password to get into it. You can get to all the materials that we have out there and available to you. So with that, I will take a breath, kick it back to Beth. If you saw any questions or come through, more than happy to answer them.
I don't see any questions, but I will go ahead. We have 3 polling questions I hope that you all participate in, so I'll do those real quick. First is, would you like to learn more about how we can assist you with your IUL sales? Next, would you like more information about our life and annuity academies? Okay, and last, are you interested in getting appointed with Allianz? While they're voting, Paul, thank you again for hosting this with me today. I learned something new every time I listen to your presentation, and I would let everyone know that we will be posting this on our YouTube channel. Paul went through a lot of great material about Allianz. So just know that if you want to go back and review it, it will be available on our YouTube channel. Of course, you can ask any of the life insurance sales directors if you have questions too. Anyway, thank you all again for joining us on this Monday. I hope you have a wonderful week, and I hope to hear from you soon. Again, this is Beth Rickliff, Life Insurance Sales Director. Have a great week. Thanks, Paul.
Thank you.